This presentation explores a relationship between free enterprise and entrepreneurship. A market economy creates opportunities by allowing individuals and businesses to respond to demand, develop new ideas, and compete for customers. But opportunity alone is not enough. Entrepreneurs are the engine that turns opportunity into action. They identify needs, accept risk, organize resources, and create value through new products, services, and businesses. Together, free enterprise and entrepreneurship help drive innovation, economic activity, and forward movement in the marketplace. A free enterprise economy, also known as capitalism or a market economy, is a system in which individuals and businesses make most economic decisions themselves, with limited government intervention. Three ideas are central to how it works. First, private ownership means people can own property and businesses. Second, voluntary exchange allows buyers and sellers to transact freely, with each side choosing whether to participate. Finally, price signals communicate supply and demand, helping guide what gets produced, how much is available, and what consumers are willing to pay. Free enterprise rests on 5 connected pillars. Private property means individuals can own assets and decide how to use them. Freedom of choice allows people to determine what they buy, sell, or produce. Competition brings rival firms into the marketplace, encouraging better quality and lower prices. The profit motive rewards entrepreneurs for taking risks and creating value. Finally, limited government establishes rules that protect rights, while avoiding unnecessary control over market decisions. Together, these principles give individuals room to participate, innovate, and respond to what others need. Adam Smith described this coordinating force as the invisible hand. In a free market, people make decisions based on our own interests, yet those choices can produce broader benefits for society. When demand is greater than supply, prices rise, encouraging more producers to enter the market. When supply exceeds demand, prices fall, signaling producers to scale back. Through these changing prices, millions of individual decisions are coordinated without requiring a central planner to direct every action. When economists describe production, they usually point to 4 essential factors: land, labor, capital, and entrepreneurship. Land provides natural resources, labor supplies human effort, and capital includes the tools and resources used to produce something. But entrepreneurship brings these pieces together. The entrepreneur is a catalyst, identifying opportunity, organizing resources, and creating goods or services people value. Unlike passive resource owners, entrepreneurs take initiative and accept risk, hoping for a profit. Without that coordinating role, valuable resources may remain unused rather than becoming productive economic activity. Entrepreneurship is more than simply starting a business. It begins with recognizing opportunities, especially unmet needs or inefficiencies that others may overlook. It also requires risk tolerance, the willingness to accept financial, personal, and professional uncertainty while moving forward. From there, entrepreneurs mobilize resources by bringing together the people, capital, and tools needed to pursue a vision. Ultimately, the goal is value creation, delivering something customers genuinely want and will pay for, while doing so in a profitable way. These capabilities work together to turn an idea into a sustainable venture. Entrepreneurs play a role far beyond launching individual companies. Their decisions create ripple effects throughout the economy. First, new ventures create jobs, giving more people opportunities to work and helping reduce unemployment. Second, entrepreneurial competition drives innovation, encouraging businesses to develop better, more effective solutions. Finally, when companies succeed and grow, they contribute to wealth generation through higher economic output and increased tax revenues. Together, these effects show how entrepreneurship can strengthen the broader economy, not just benefit the founders themselves. This slide shows how profit and loss guide decision-making in a market economy. An entrepreneur takes a risk by committing resources to a particular product or strategy. The market then responds to consumer choices, creating either a profit or a loss. Profit is information, not merely a reward. It shows that resources are being used in ways consumers value. Loss communicates the opposite, encouraging the entrepreneur to adapt, reduce costs, reallocate resources, or exit. This feedback loop helps free markets correct themselves over time. Competition is what keeps free enterprise honest. When one entrepreneur earns a profit, that success attracts others into the same market. New entrants put pressure on prices, encourage better quality, and give consumers more choices. This process is known as creative destruction, a term coined by economist Joseph Schumpeter. The central lesson is that success is never permanent. Businesses have to keep innovating, because a more agile competitor can quickly improve the offering and displace companies that stop adapting. Continuous innovation is the price of staying competitive. A credible business plan connects entrepreneurship to the realities of a free enterprise market. A strong business plan doesn't fight the market, it leverages it. First, identify the market gap by clearly defining the unmet need your venture addresses. Next, analyze the competition and explain how your offering will stand apart. Then, project profitability by showing how revenue can exceed costs over time. Finally, demonstrate value by providing evidence that customers are willing to pay for what you offer. Together, these elements turn an idea into a compelling business case. The key takeaway is that free enterprise works through coordination, not central control. Markets connect supply, demand, and prices, while entrepreneurs combine resources, take risks, and create value. Profit and loss guide those decisions, and a strong business plan demonstrates a clear understanding of these market dynamics.